This presentation deals with risk and uncertainty modelling. The important thing about DCF models is that all of the numbers in the body of the model are forecasts. This is important because as forecasts, none of them are known for sure. If you look at the popular debates over where interest rates are going, it becomes very quickly apparent that very few people know where interest rates are going to be in a month's time, let alone forecasting them 5 or 10 or more years into the future. Yet this is exactly what is demanded by DCF analysis. Not only are we trying to estimate something which is known to be fairly difficult like interest rates, but we are actually estimating forecasts of all of the variables in our complete model. Some of them are fairly reliable, and so, for instance, the cost of management is always going to be relatively close as a percentage of the rents, but some are highly variable. Our DCF model aims to include all the future cash flows, and therefore we must forecast reliably all future variables. The end value of the property investment is actually a very critical variable. Unlike many other financial projects, such as running a production line, where at the end of a few years a set of machinery might be worth very little, the end value of a property investment is usually anticipated to grow over time, and so it becomes a very major issue. We'll be coming back to the estimation of this end value of property and the problem with its forecasting a little later. Overall, the pricing of real estate comes down to a tussle between the vendor and the purchaser. Both would like to see the best outcome. The vendor expects that property value is the present value of all the future returns, all the future rents. Overall, financial success comes from being able to have a better estimate of the future than the market. It really comes from outguessing the market. When we talk about risk in financial management, we're talking about the likelihood of guessing the future less effectively than the market. Overall, finance and property investment is speculative, and this means that the income all comes from insights into future events. That is fundamentally different, say, to earning an income from brewing beer or baking bread, where the income comes from actually producing something. Here what we're doing is aiming to take a profit, a benefit, as a result of some error in market pricing. All financial value is considered to be the present value of the future returns of some particular investment. It implies an agreed discount rate. The selection of the discount rate proves to be one of the more challenging variables in our discounted cash flow analysis, but for the present we will assume that the community in general has an idea of what the appropriate rate of return is. Without a rate of return, the future benefits, certainly of property, are simply their numerical sum, and considering property is considered to be a perpetual asset, this means its future benefit is actually infinite. Obviously, that's not very practical. Property value is the present value of all future rents, or more specifically, the present value of all net future rents. The vendor sets the price at the market estimate, and this is largely what valuers do. However, the purchaser would consider that they have purchased successfully if the future rents turn out to be higher than the market expects. The object, therefore, of discounted cash flow analysis is to analyse the future using your own best estimates of the future in such a way as to identify properties or other investments where the market undervalues them. Those are opportunities that are worth buying. Likewise, funds managers are constantly involved in modelling with a view to seeing which of their assets the market values higher than the organisation does itself. These become the assets that the fund is likely to liquidate. The idea of outguessing the market while is appealing, is not without its difficulties. Notionally, the whole concept of economics is based on the idea of perfect markets. Perfect markets and market efficiency are closely related. In finance markets, we look more to market efficiency because the criteria for market efficiency is a little softer than market perfection. Farmer, 1965, recognised 3 possible ways in which markets can be efficient and formulated what is known as the efficient market hypothesis. Farmer's efficient market hypothesis comes in 3 forms. The first form, the weakest form, known as the weak form, is that all historical data is reflected in the current prices. If Farmer's weak form efficient market hypothesis holds, it would suggest that current price for any asset already includes an accurate estimate of all of the historical data. This would mean that there is no point in researching the history of price movements because the current price already is the best estimate of what their value is in terms of where they're going. There is a whole arm of financial analysis given to looking at past trends and projecting these into the future in an effort to take a benefit from the market. People involved in this activity are referred to as chartists because they tend to use charts or graphs of past behaviour to predict the future in the attempt to outguess the market. Obviously, chartists do not believe in weak form efficient markets. The second version of Farmer's efficient market hypothesis is the semi-strong form. This suggests that not only historical data, but all currently available public data is reflected in current prices. The semi-strong form looks not only at past trends, what the chartists look at, but also recent announcements, such as discoveries of new mines for a mining company or some technological development increasing the efficiency of some other factory or industry. If the semi-strong form of the efficient market hypothesis holds, then there is no point combing the newspapers for news of new events or the impacts of possible changes on investment prices. This is because it's assumed that the market has already captured these in the current price. This means that if BHP was to announce a new find of iron ore somewhere in Australia, or perhaps oil, that would be very quickly factored into prices. In the finance markets, in the share market for instance, share prices do react very quickly to relatively minor pieces of information, such as the change in political policies and so on. Property tends to be a little slower. You need to be a little bit wary though, because the semi-strong form is sometimes reflected in changes that happen even before the public information is available to the community. This leads to Farmer's third form of the efficient market hypothesis, the strong form. This suggests that all internal and external data is reflected in current prices. There have been studies that have found that share prices tend to reflect changes in public announcements, sometimes weeks ahead of when the announcements are made. This would suggest that insider trading is actually quite substantial in the finance markets. Likewise, in the property markets, sometimes you'll find that the expectation of, say, zoning changes is already factored into the pricing of real estate well before the zoning is actually made. This can affect planning changes such as land use, but also announcements relating to infrastructure, say new roads or railway lines. If the strong form of the efficient market hypothesis holds, then the current prices is the market's best estimate of the correct price for all information, both historical, present public, and also present internal data. It leaves little wiggle room for finding benefits in the market. The result of the efficient market hypothesis, if it applies, would be that the resultant change in prices beyond what is available from the market really gives way to little more than a random walk in prices, largely due to errors in pricing. It means that there's no residual useful information available to investors, and therefore no forecasting opportunities. It's very difficult to learn effective forecasting or effective ways of beating the market, because you will not find it in any textbooks. This is because if we were able to give you at CQU a way of beating the market, and we send a drove of graduates out, those graduates would very quickly use their market knowledge to buy and sell, and in so doing affect the prices in such a way that all of the benefit would be lost. Little by little, once everybody knew how to predict the market following those insights that we taught you, they in turn would be factored into the market, again leaving no benefit. Property is a little bit more complex. While we can apply the efficient market hypothesis to property, property tends to move more slowly. There's also a far greater variety in the opportunities to use property, and this is something which is not available in the equities market. In buying property, I have the opportunity to custom design the way that I use it. This may be in terms of the way I promote the property, the way I organise a strategy for my leasing. It might also include my financial strategy in terms of the amount of debt or other capital structure arrangements that I might make. To some extent, these possible benefits come from the shrewd use of property and perhaps the adventurous use of financing resources. Is not necessarily from the market itself. Largely, financial opportunity, in other words, the prospect of actually gaining extraordinarily from investment in either the finance or property markets, comes from market failure. Market failure is the economist's term for situations where markets do not behave in the efficient or perfect way that is predicted or assumed in economic theory. The reality is, of course, that there is considerable financial opportunity out there in the market, and this is simply recognition that there is no such thing in practice as a perfect market. And the investment markets, even with their softer requirements of efficient market expectations, also give many financial opportunities, again showing that market failure is the norm rather than the exception. Overall, we can conclude that markets are not efficient, and so by not being efficient, apart from making all of our economic theory redundant, it does give us the opportunity to at least be able to see a benefit in advanced analysis, such as discounted cash flow analysis. Having established that there is a point to doing financial analysis, and this is because the finance markets are a real example of the failure of economic theory, we can move in and look at the practicality of actual forecasting and the notion of risk. First of all, we've noted that risk is outguessing the market. We can more specifically define risk as the likelihood that your forecast will not be realised. While this definition is very general, we can break down our risks in a number of ways. The most useful initial breakdown is between systematic risk and unsystematic risks. Systematic risks are those that are general, knowable, and manageable. The important thing about systematic risks is that they can be controlled in some way, because while they're always an uncertainty, they can be managed. Whereas unsystematic risks are highly unpredictable, tend not to have simple causes, so they're spurious. Largely what we're trying to do with many investment strategies is control our systematic risks, and so our only resultant exposure is to the unsystematic risks that, well, at least conceptually, no one can predict. While we're dealing with the notion of risk and the notion of not realising our forecasts, it's important to remember that there are two types of ways that a forecast may not be realised. Most of the time when we think about risk, we think about loss. But equally well, our forecast might not be as optimistic as the world turns out. We refer to this as an upside risk. What happens if I expect that my rents are going to rise by 10% next year, but in fact they rise by 20%? I can say my forecast is a failure, but on the other hand, I've made more money, and so I'm hardly going to be upset. We need to be a little bit wary of upside risks as we look at some of the methods of quantifying uncertainty and the appropriate returns. Because it turns out that usually we don't consider the upside risk as a risk at all, even though to a statistician the fact that the forecast has failed is equally serious, whether it's positive or negative. We can look to a number of sources for our forecasting, especially we can look to the market. Forecasts for some figures can be taken from the markets themselves. In the case of interest rates, while we may have a variable interest rate for our property mortgage, we can look at the fixed interest rates applicable to both mortgages but also fixed deposits and other long-term interest-bearing investments to give an indication of where the markets are going. We'll be coming back to this when we investigate the liquidity preference theory of interest rates in another class. A second common form of forecasting is professional forecasters. There are a number of individuals and organisations that are devoted to doing nothing more than provide forecasts. These, of course, often do their forecasting for some form of an income, and so BIS Shrapnel, for example, is able to charge considerable subscription fees for people who want to use their forecasts. There are others, however, that operate forecasting services as part of their services to their clients. These include major banks and other financial organisations. The third form is gut feel. Where do we think or feel the markets are going? While this might seem a rather trivial source of forecasting, what we will find is that it actually has prominence in many, many different places as we dig deeper into the practicalities of getting estimates of where the future is going in property. When we go now to our discounted cash flow model, we find that there are many ways of classifying and organising the various variables. The first thing we'll notice is that there are a number of dollar-denominated variables. There's also a series of rates. The rates include the interest rate, the discount rate, the inflation rate, the market growth rate, and possibly others, such as various escalators, such as the building price index, which is an inflation rate specifically for the building industry. These rates typically come from the environment, from the market, and their prediction, being public and important figures, is something upon which there is considerable public discussion. The dollar rates relate more specifically to the property parameters. We can split these into the parameters relating to the purchase and sale of the property and the parameters relating to the operations, especially to rent and expenses. An understanding of the property market helps considerably in the estimation of these parameters. Like any industry, the more experience you have with dealing with the values in the industry gives you the best ability to be able to respond quickly when opportunities arise. There's a second way of classifying the variables, and this is to classify them between internal versus external variables. By external, we mean those variables that are set by the markets. Of these, interest rates are a good example, but there are many, many others. The important thing about the external variables is that there is nothing at all that we can do in managing our property that can change the way that these variables behave. They are like the weather, we're simply subject to them. By contrast, we have the internal variables. Largely the internal variables include things like leverage, perhaps a maintenance policy, or management. Many of the internal variables are chosen by the investor. This is very important because given the external variables that set the environment in which the investor operates, the internal variables always should be looked at as areas where the investor has control. And by changing the settings of these internal variables, the investor may be able to fine-tune the investment so it does in fact outperform what other investors are doing. Having said that, it's important to be aware that once the internal variables are set, often it is difficult to change them. This is especially the case with, say, leverage. Leverage is the amount of debt which the investor brings in to help finance the property acquisition. While notionally the investor may have many bags of gold lying under his bed available to be able to pay off the bank at short notice, usually this is not the way investors work. Usually an investor will apply all of their equity funds as a deposit against a property and borrow the remainder. This means that the investor is in no position to change the leverage ratio at short notice unless the property is sold. If the economic environment changes adversely, then the investor is basically stuck by the leverage decision that was made at the acquisition of the property. This means that the choice of internal variables should be done very carefully at the beginning of the project, because although they can have quite an effect on the apparent profitability, they also have quite a major impact on the risk exposure to the investor. Having divided the variables into internal and external, we then come to the question of whether the discount rate is internal or external. It's easy to see that the market will set things like the interest rate and the rate of property growth. But who sets the discount rate? It's considered to be the required rate of return that the investor expects in order to invest in this particular investment rather than some comparable other investment. We'll be seeing later that this infers an awareness of some sort of risk loading for the class of investment that the property represents. But does this mean that it is set by the market? A property may perform well on a discount rate of 10%, but fail miserably at a discount rate of 20%. Why is it that the investor chooses a discount rate of 10 or 20%? Especially since both of these represent a profit. This question is something that property professionals and anyone involved in finance should give some thought to. It's easy to say that the 10 or 20% represents what is available in comparable investments. However, when you look closely, you'll find that it's not quite that easy. Even the simple comparison between whether it's better to invest in property or shares on the share market is something that continues to be debated, even though the various risks have been investigated for literally decades and decades. Why is it that we can't get an answer to even this simple question? It seems that the discount rate is in fact a subjective rate. It's one of the reasons why financial advisors need to be very careful to make sure that their advice is given sensitive to the needs of the investor. This is not an area that valuers are normally given to spending a great deal of concern over. However, ultimately, we find that all discount rates do have this subjective element. They relate to the disposition of the investor. When we look more closely at these implications for what it says about valuation, what we find is that investors who are willing to accept the lowest discount rate will tend to put the highest value on particular assets. This would suggest that property prices are set by a class of investor that have a particular outlook as far as discount rates go. That is, they're willing to operate on the lowest discount rates, regardless of what the market is doing. Having considered the variables in terms of internal and external, we can then move to looking at matters of control. In finance, it's common to talk about exposure, and this means the level of susceptibility to risk, in other words, financial loss, due to some change in an external parameter, a finance risk. For instance, if interest rates move, usually up, perhaps even down, how will this affect our property investment? If we find that we have very low leverage, in other words, we haven't borrowed very much money, it's likely that our exposure to interest rates will be very low. We can sit back and grin while other highly leveraged investors go bankrupt. However, in property, that is a rare case for a property investor to be in, due to the high use of debt funding in most property investments. We mentioned earlier on that a unique aspect of property DCFs is that the notional sale, the end value of the project, is quite high, because property tends to appreciate over time, and usually investors expect a part of their overall return will come by way of capital gain on their property assets. This means that there is a property market risk, which is very important to property investors. Put a different way, it's the question of where prices or demand will be when I sell. This is important because I may find an investment opportunity that appears to provide a very strong yield. It just might be, though, that it's in an area that for some reason, in the longer term, is not going to be so attractive. This is particularly the case with regional residential investment. It can also be the case in various circumstances in urban situations. Examples such as buying service stations, but not realising that there is going to be a major bypass that will take most of the traffic away, is an example. Most retailing, certainly in the area of conventional shops, is now exposed to the risk of shopping complexes being opened nearby that will drain much of the retailing activity away from an old main street. There are many cases such as this, where changes in the community through changes in practice, changes in infrastructure, and so on, change the long-term benefits of property or the long-term demand for property. A third area of risk is known as documentation risk. This relates to legal problems arising from the property investment. Documentation risk is particularly a concern in property development, where the construction documentation can be extremely complex, but also can be related to the pre-sales contracts and others. In property investment, leases can have a huge number of pitfalls, making it very important to very carefully consider exactly what are the terms of the lease and what risks do they expose the property investor to. Not only is the form of the lease important in terms of what is and isn't covered, but also the effectiveness of damages clauses in cases where there is some violation of the contract,